Well, and in breaking news, the US economy slid into a recession after it shrank by an annualized 0.9% in the second quarter. That follows a 1.6% drop in the first quarter, and it misses analyst estimates of 0.4% growth. Now, Steven Blitz, chief US economist at TS Lombard, joins us now. Steven, US enters a technical recession by common definition. That's 2 quarters of contraction. But the White House has stressed of late that the official classification is made by the National Bureau of Economic Research Analysis, which looks at, several indicators, including the labor market and spending. So is the US in recession or not?
No, it's not. Anytime you've added the kinds of jobs that you're adding, almost 3 million jobs in the first half of the year, that's not recession. I think what you're seeing is the unwinding of a pace of growth that was not sustainable. We had 6% real growth last year, built on the reopening of the economy after the COVID lockdowns, and that was spurred even faster by all the fiscal transfers. And the economy now is in the process of moving back towards 2% real growth, which is trend. So if you think about it, you're moving a third of the growth rate that you had, and that adjustment down is what's coming through. Now, now that's not to say that consumers aren't being squeezed by higher prices, and that you're seeing some reduction in the real spending for discretionary items. But interestingly, while we saw that in April and May, real spending on discretionary items picked up in June. And again, that reflects the fact that you have strong job growth and you still have very strong nominal wage growth, growing around 7%. Annualized over the last 3 months.
Well, Steven, so you said it is, though, like a sign of the economy decelerating. So then what is your outlook for the rest of the year? Could we see it go into a recession at some point in the quarters down the road?
Yeah, I think the economy does enter a recession in the fourth quarter. So I think part of it, it's confusing the economy, not just here, but everywhere, because there's 2 cycles running at the same time. There's that COVID contraction and boom from the reopening. And then you have underneath that a normal business cycle. And this normal business cycle is carrying a very high inflation risk. And the Fed is pushing against that by increasing the funds rate. And I think the funds rate is going to get to 4% by the end of the year. And that plus the negative loss of wealth in the equity market and also high prices is going to create a recession. I think the labor market's already softening. We're seeing that. We have some higher initial claims in unemployment. Anecdotally, we're reading a lot about layoffs in the tech sector. So I think that there is a recession coming. This isn't it. But there is a recession coming. And in fact, it wouldn't surprise me if the third quarter increased and then the fourth quarter was a decline and a more traditional looking recession with drops in real incomes, real spending, and most importantly, declines in employment.
Yeah, so do you think this pain is going to push the Fed to sort of not push interest rates not hike interest rates too much in the coming months?
Well, no, I don't think so. But I do think that once the recession starts, and once you start to see, look, maybe I'm wrong. Maybe employment starts to decline sooner than the fourth quarter. Whenever that happens, the Fed has always stopped increasing and usually begins to cut. And therein lies the real problem that's going to face the Fed, which is that inflation's still going to be too high to their 2% target. Employment's going to be dropping. Powell said that, look, they've got to keep a level of interest rates that's going to keep unemployment high and growth low for an extended period in order to drop demand enough to get back to that 2% inflation rate. And I question whether or not they really will have the resolve and the political backing, not just from the White House, but from Congress. Congress is really their boss. And whether or not Congress will give them that political support to sustain 5.5%, 6% unemployment in the name of getting back to a 2% inflation rate. And I suspect they won't. And I suspect by this time next year, we'll be talking about the Fed changing its target from 2 to 3% in terms of inflation.
And Stephen, if I could just ask you this very quickly, for investors looking for some relief, is there more certainty now that we see the trajectory that the U.S. is on, and how's that going to affect markets?
Well, I'm not sure about certainty. I mean, if there was certainty, markets would return you a treasury bill. The reason they return more is because there is uncertainty, and there's an awful lot going on in the world that is in these shifts and changes in the U.S. economy. So I think certainty is. I think all we know is that the Fed's going to be sensitive to a decline in employment and adjust accordingly. And I would say to investors to expect a higher inflation world beyond the next 6 to 9 months, and that a return to a 2% growth, 2% inflation world. Just think of that as a unique 25-year period in time that is unlikely to be repeated.
Right. Thank you so much for that, Steven Blitz there from TS Lombard.